this is indeed an honor. Joining us now, he's been extremely active on Global Wall Street in the last 4 or 5 days. James Chanos is with Chanos and Company, definitive on the street of a cautious view. Jim Chanos, honored to have you here. Let me just cut to the chase. What is a distinctive feature that makes SpaceX remind you of Enron?
Well, I don't know that it reminds me of Enron, Tom, but it reminds me of the Enron time frame. How's that? In that I've always said that Wall Street has a printing press too, just like the Fed. It just takes a while to get going. And one of the things that I think SpaceX is ushering in 2026 is massive equity issuance. And historically, without a doubt, in the 20th and 21st century, anytime you have seen massive IPOs and secondaries relative to the size of the market or the economy, investors generally have been advised to be a little more cautious or reduce their risk. So that 1999, 2000, 2021, for the first half of that year, during the meme stock and SPAC craze, we are now going to break records in 2026 for IPOs and secondaries. And SpaceX, of course, is the granddaddy, kicking it all off in a big way. But we're going to see OpenAI and Anthropic and probably some others. So we're going to shatter records. And so it's telling you that right now supply is meeting demand, which we haven't seen, by the way, in 23, 24, and 25. But we're seeing it now in 26.
I look, Jim Chanos, at this, and we've got a wonderful amount of time here with Mr. Chanos. So much to talk about. Scarlet's got some themes. I have some themes as well. Ed Ludlow fronted me. Did you see how he did that?
Yeah.
Ed Ludlow just stole my thunder here.
He needed to do it.
Chanos is thinking about the Neo Cloud. This is the team here. The New York Times article of a day or so ago. Is SpaceX worth $1.8 gazillion? XAI seems to be suddenly changing its business model from developing models like Grok to basically becoming an Ed Ludlow neocloud. The entire valuation rests on XAI's progress. The neocloud strategy is a commodity business that is valued far lower on the public markets. Jim Chanos to Isaac and the crew over at the New York Times. They're talking innovation, but you're predicting they'll go safe?
Well, what's really interesting, Tom, is that about a week, 10 days ago, the vast driver for the SpaceX TAM in their prospectus was the enterprise solutions for XAI, basically Grok, what the models produce, right, the software. And instead, they basically did a 180 pivot and said, we are going to lease out our capacity to Anthropic and Google. And that's the neocloud model, right? That's you're an equipment lessor. And that is a much lower valued business in the marketplace than being a model company or a hyperscaler. And we've been following data centers for a long, long time. And basically, it's a finance business, right? You're buying the chips from NVIDIA or somebody else, and then you're leasing them out to Anthropic or whatever. It's a rate of return business. It's not a super high-tech business. Yet 22 plus trillion of the 29.5 trillion of SpaceX TAM in their prospectus was based on that business. And it just struck me as very, very odd that right before the IPO, they would pivot to a much lower margin and lower valuation business than the hopes and dreams, which you guys have mentioned, I've mentioned, based on producing these wonderful AI agentic software products from Grok. And it's one of many head scratchers about this deal.
At what point does financial reality, the kinds of things you were just talking about, breaking down the numbers, become more important and matter more than the storytelling, the hopes and dreams part of it? Because that's what Elon Musk excels at, and that's what people are buying in on. So
the question is does the Elon premium, is it Elon premium times 2 or Elon premium divided by 2? I think that's really the question here, because there are people who believe in Elon and have bid up Tesla accordingly to well beyond where I think most fundamental analysts think it's worth because of Optimus robots and autonomous driving and all that good stuff. And now you have another Elon hopes and dreams company with an even bigger valuation. And so does that double the value, or does it basically say, okay, well, I'm going to pick one? Because neither of them, let's face it, are being valued on their operations. SpaceX is, I believe, depending on what I heard in the green room, is probably now at about 110 times revenues. And just history tells us you just never really make much money buying equities at over 100 times revenues.
Yeah. Well, you, as we know, are inherently skeptical. Your company name's Kynikos, skeptic. You're not being a bull on SpaceX or Tesla or Elon Musk completely tracks. Is there anything in the SpaceX financials or Musk's management of the company that does impress you that you can say good job on?
Look, I think Starlink's a real business. We can look at their businesses. Again, we have to go on what's in the prospectus. Starlink's a real business. It's growing. It will probably continue to grow, although its growth is slowing. The launch business is still losing money after 22 years. And I'd be remiss from my fellow glass half empty participants if I didn't point out that the rocket that all of this depends upon, Starship, still has not achieved Earth orbit in 12 missions, right? And half of those ended up with some sort of mishap. So there's a lot riding on all of that. I think Starlink is a real business. It's worth a couple $100 billion. But the real hopes and dreams here is on XAI, which is, by the way, a company they bought in February for $250 billion in stock, that the market is now valuing it probably well over $1.5 trillion. On
Bloomberg Television, on Bloomberg Radio, worldwide with us, Jim Chanos, thrilled he could join us today in this historic moment for his Wall Street and all of us around the world. So the short crew is said Tesla, somewhat like SpaceX, and I'm enjoying a 53% per year return since sort of the beginning of COVID, back 6 years or so. So, again, Tesla's done better than good, and there's a modeled negative free cash flow right now. How long can the optimists of SpaceX keep this going without delivering a more conventional income statement?
Well, I think you answered the question, right? Years, if possible. But Tesla is trading at about 14 times revenues, right? It does have $100 billion in revenues, and it ramped revenues pretty quickly in 2019 and 2020. So there is a real business there in terms of large amounts of revenues and some cash flow. It's not trading at 110 times revenues. And that's a magnitude of difference, I think, that's really important for your viewers.
I've got, just for the first time, Scar, I've ever looked, the famed BQ function on the Bloomberg. And of course, Chanos nails the price to sales because he studied Tom Galvin years ago. I've got right now I've got a number of 27 times revenue on the BQ screen. It may be a little higher than that. I've never seen a stock like that.
So I'm glad you guys bring up Tesla because there's this expectation that Tesla and SpaceX will somehow merge or will be combined in the same way that XAI and SpaceX got combined and merged. How are you thinking through that? And what does that mean for investors who believe in the Tesla business but are maybe skeptical of SpaceX?
Well, again, if it happens, and I have no idea if it will happen or not.
Does Elon need to make it happen?
No, he doesn't need to make it happen. He can keep them separate if he wants. It's solely up to him. We all know that. But it would be an equity for equity deal. And so I don't know, how much value that would add in terms of cutting overhead is not the story here, right? It's really what these companies will produce in the next 5-10 years.
I look at this, Jim Chanos, as an historic moment. And the answer is to the cycles. And I opened up talking about Enron and all that. I want you to talk about the short business right now is a hugely important part of financial society in this great bull market we're in right now. There's a lot of scars out there. How do you keep that going when you see SpaceX right now? How do you keep a short model going with bull sectors and a bull trend in the broader market?
So through 2023, we're running outside money. Now we run our own money. We've been hedged in the short world since 1996. Basically, our view has been we don't know where the market's going, and nor does anybody else. So we'd rather be long the market and short our collection of radioactive companies, if you will. And that's been a very profitable business. And it's been a very profitable business for the last few years, too, despite the market hitting new highs, because there've been a lot of stocks, as you guys know, that have lagged dramatically. So our view is always be long the market and be short some percentage of companies with bad businesses. And I think that's nothing I would recommend your viewers to do at home. All right, I don't recommend short selling for most people. It's really for the pros for lots of reasons. Things like getting an interest rebate on your shorts and a variety of other things. But I will say that one of the things right now that is very apparent is that insurance is cheap.
Right.
And it's cheap for all the reasons.
I don't want to interrupt because Scarlet wants to get 4 more questions in. Is SpaceX radioactive?
We'll have to see where it settles out. You can't short it right now anyway, so it's a moot question. I mean, I think that anything trading over 100 times revenues is of our interest. Historically, returns have been awful at those valuations.
You mentioned earlier the dot-com bubble. Are we doing dot-com bubble 2.0 right now?
Oh, this is much bigger. The AI build-out relative to the TMT build-out of 99, 2000 is multiples, even as a percent of the economy, GDP. And an important thing to point out is that when you get these CapEx booms in technology, they're tremendously accretive to earnings. And there's a simple accounting reason why. That is, when Tom buys chips for his data center from NVIDIA, NVIDIA recognizes that as revenue and profit. Mm-hmm. Tom capitalizes those expenses and writes them off over 5 to 10 years. And so you have a mismatch where the same dollar in a CapEx boom is recognized as profits by one entity and deferred by the same people expending the dollar. And that happened in 90, 98, 99, 2000. From the middle of 98, S&P operating earnings rose 30% to the middle of 2000 over the 2 years. From the middle of 2000 to the middle of 2001, when order books got pulled, S&P earnings dropped 40%.
Was that too much accounting for a Friday? I think so.
I'll leave it. I'll stop at that.
Jim, let me ask you one last question before we let you go, because this is Bloomberg Money after all. How do you approach your own financial planning? How does it compare with how you advise or manage money for others?
Well, it's mostly in my business and in ancillary things since I'm semi-retired right now, and I'm advising people, not directly running their money. So it's pretty conservative. So you set and forget, or you do make a lot of changes? It's mostly passive. Again, for most people, I think that's the way to go.
Jim, we got our merch over here. Scarlett's got her Knicks jacket here, ready to go.
Let's go Knicks, Knicks in 5.
She and Anne-Marie Horton are going to San Antonio. Why aren't we seeing you in the front row quickly here?
Well, first of all, I live in Bucks County, Tom, so I'm outside of Philly.
So you're doing a 76ers.
Secondarily, my sons who were born in Manhattan are diehard Knicks fans, but I'm a Milwaukee Bucks fan. I'm a cheesehead.
I knew I was going to hear that. We just had to get that for the record as well.
Jim, thank you so much for joining us today. Really appreciate it.
Thank you so much for having me.